For years, we were told the same thing, over and over again. Car prices are not going back to where they were. The shortage is structural. Inventory will stay tight. Dealers have the leverage now, and buyers simply have to accept it. That was the narrative that dominated automotive coverage from 2021 all the way through much of 2023. And millions of Americans believed it because the data at the time seemed to support it. Used cars were appreciating like investment assets. New vehicles were selling above sticker price within hours of arriving on lots. The idea that any of this could reverse seemed almost impossible to most people who were living through it. But here's what we know now. The data has shifted, and it has shifted fast. Inventory is rising. Wholesale auction prices are falling. Loan delinquencies are climbing at a pace that credit analysts are watching with growing alarm. And in the most stressed segments of this market, the price corrections already underway are not small. They are not temporary, and they are not finished. The auto correction that has begun may be one of the most significant market reversals of the last 2 decades. And today, we are going to walk through exactly why, with the numbers, the credit signals, and the structural forces that are now pushing this market in only one direction. To understand where we are going, we have to be honest about where we've been. The pandemic created a set of conditions that were extraordinary, temporary, and almost perfectly designed to inflate an asset bubble. Semiconductor shortages crippled vehicle production at every major automaker simultaneously. Factory shutdowns across Asia cascaded through global supply chains. The result was a collapse in new vehicle inventory that pushed days supply at American dealerships from a healthy 60 or 70 days down below 20 days at the worst points of the shortage. That supply vacuum alone would have been enough to push prices higher, but it did not happen in isolation. At the exact same moment, the Federal Reserve was holding interest rates at near zero. Stimulus checks were flowing into household accounts. Rental companies that had liquidated their fleets in the early months of the pandemic were rushing back into the market to restock, competing directly with regular consumers for the same scarce vehicles. The combination of those forces, collapsing supply meeting surging demand in a sea of cheap credit, produced price increases that broke every model analysts had used to understand this market. The Manheim Used Vehicle Value Index, the gold standard benchmark for wholesale used car pricing, rose by more than 50% from early 2020 to its peak in January 2022. Average transaction prices on new vehicles climbed to record highs. Dealer markups of $5, $10, even $15,000 above MSRP became routine. And the buyers who needed vehicles had no real choice. They paid, and they financed those purchases at those inflated prices, building loan balances that were detached from any rational, long-term valuation of the underlying asset. That is the foundation on which this crisis is now unfolding. Because the conditions that created the bubble have not just eased, they have fully reversed. The chip shortage is over. New vehicle production has normalized, and in several categories is now running ahead of pre-pandemic levels. Automakers who spent 2 years unable to fill their own order books are now pushing inventory into a market that has changed fundamentally. Day supply figures are recovering toward normal. Wholesale auction prices have been posting consecutive monthly declines. Dealer lots that were empty in 2021 are filling back up. And in some segments, the buildup is happening faster than retail demand can absorb it. At the same time, the interest rate environment that made all those inflated purchases feel affordable has been completely dismantled. The Federal Reserve's rate hiking cycle pushed borrowing costs to levels not seen in decades. The math of what that does to monthly payments is stark and unavoidable. A consumer financing a $35,000 vehicle at 3% interest was looking at a monthly payment that, while uncomfortable, was at least manageable for many households. That same consumer financing the same vehicle at 8% is looking at a payment that is hundreds of dollars higher every single month. Multiply that dynamic across millions of potential buyers, and what you get is demand destruction on a significant scale. The pool of consumers who can afford to participate in this market at current price levels has shrunk considerably, and when demand contracts while supply expands, prices fall. That is not a prediction. That is arithmetic. Now, here is where the story moves beyond a simple price correction and into something that carries considerably more systemic weight. The problem is not just that prices are falling. The problem is what those falling prices are doing to the loan portfolios that were built during the boom. Subprime auto loan delinquency rates have been climbing steadily. The percentage of auto loan balances that are 60 days or more past due has been rising, and the pace of that rise has been accelerating. Fitch Ratings and other major credit monitoring agencies have flagged this trend with increasing concern. The borrowers at the center of this stress are the ones who are most aggressively targeted by lenders during the peak of the market. Lower income households, extended loans at elevated rates, purchasing vehicles at inflated prices, often with minimal down payments and loan terms stretching to 84 months or beyond. Those borrowers are now in a position that has no good exits. Their vehicles are depreciating faster than they are paying down principal. Their monthly obligations are consuming a rising share of household budgets that are also being squeezed by elevated rents, higher insurance premiums, and persistent inflation across essential spending categories. They are underwater on their loans, and the water is getting deeper every month. When borrowers in that position run out of options, they default. And when defaults hit a critical threshold, repossessions follow at scale. Repossession volumes have already been rising. And this is the mechanism that transforms a price correction into something that can produce the kind of dramatic declines that sound extreme until you understand the mechanics behind them. Repossessed vehicles flow into wholesale auction lanes, adding to a supply that is already elevated. That added supply pushes prices lower. Lower prices push more borrowers into deeper negative equity. Deeper negative equity generates more defaults. More defaults generate more repossessions. More repossessions generate more supply. It is a self-reinforcing cycle, and once it reaches sufficient velocity, it is very hard to interrupt. In distressed asset categories, the combination of organic price correction and forced liquidation selling can produce peak to trough declines that bear almost no resemblance to what the same vehicles were selling for at the height of the market. That is not hyperbole. That is the observed behavior of distressed asset markets across every cycle in modern financial history. The segments most exposed to these extreme outcomes are identifiable. Certain electric vehicle models, which carried enormous speculative premiums at the peak of the market, have already begun experiencing some of the steepest depreciation curves ever recorded in the automotive industry. Manufacturer price cuts, particularly the repeated and aggressive reductions implemented by Tesla, compressed used EV values almost overnight. Buyers who paid $10,000 or $15,000 above sticker for certain EV models in 2021 and 2022 have watched the resale value of those vehicles fall by 30, 40, or in some cases 50% or more within just a couple of years. High mileage fleet inventory, auction grade repossessed units, and vehicles that were purchased with minimal equity and long loan terms are all sitting in the most vulnerable part of this market. The dealer community is not insulated from this pressure. Dealers who built their entire business model around the high margin, high velocity environment of the pandemic era are now facing a structural adjustment that is hitting them from multiple directions simultaneously. Floor plan interest, the cost of financing the inventory that sits on their lots, has surged alongside broader interest rate increases. Dealers are now paying significantly more to carry inventory that is taking longer to sell and generating less gross profit per transaction when it does sell. Average gross profit per used unit has fallen sharply from the extraordinary levels of 2021 and 2022. Dealers who overexpanded and loaded up on inventory at peak acquisition costs are under real financial pressure. And when dealers feel that pressure acutely enough, they begin liquidating aggressively. Aggressive dealer liquidation adds yet another layer of supply to a market that is already struggling to find enough demand. The macroeconomic context amplifies everything. American households are carrying record levels of credit card debt. Savings accumulated during the pandemic stimulus period have largely been drawn down. Housing costs, both for owners dealing with elevated mortgage rates and renters dealing with elevated rents, are consuming a larger share of household income than they were 2 or 3 years ago. Auto insurance premiums have risen sharply, adding to the total cost of vehicle ownership in ways that further depress demand at the margin. The consumer who might have stretched to buy a vehicle in 2022 is now looking at a financial picture that justifies waiting. And waiting, at scale, is itself a force. When enough buyers shift from urgency to patience, the psychological dynamic in the market flips. The fear of missing out on a purchase is replaced by the anticipation of a better deal in the coming months. That shift in buyer psychology suppresses demand further, which creates more downward pressure on prices, which reinforces the decision to wait. Markets have a way of overcorrecting in both directions, and the same behavioral momentum that drove prices to irrational highs on the way up can drive them to irrational lows on the way down. Historically, the auto market has been one of the most reliable early warning indicators for the broader economy. The industry's reach extends across manufacturing, steel and materials, financial services, insurance, advertising, and employment in every major metropolitan area in the country. When auto markets contract, the ripple effects move quickly and broadly. The 2008 financial crisis, during which domestic auto sales fell by nearly 40%, demonstrated just how severely an auto market downturn can interact with and amplify a broader economic contraction. The circumstances today are different in important ways, but the scale of the credit stress building inside this market is not something that can be dismissed as a contained problem. So what does all of this mean in practical terms? If you are considering buying a vehicle, the most important thing you can do right now is exercise patience. The buyer's market that is forming as a supply builds and demand softens is going to create genuine opportunities for disciplined buyers in the coming months. Focus on vehicles with well-established depreciation curves. Avoid segments that are still carrying speculative premiums from the pandemic era. Pay attention to wholesale auction data rather than retail asking prices, because wholesale is where the real signal is. And if you are financing, run the numbers carefully. The rate environment means that even a modest reduction in the purchase price can make a meaningful difference in your total cost of ownership. If you currently hold a vehicle with a loan balance that exceeds its market value, resist the temptation to make reactive decisions. Know your number. Know exactly how far underwater you are and how that gap is trending. Avoid rolling that negative equity into a new loan, which is one of the most common and most damaging mistakes buyers make in a declining market. And if you are tracking this market as a financial observer, the data streams that matter most are not the headline transaction prices. They are delinquency rates, repossession volumes, wholesale auction spreads, dealer inventory levels, and the performance of auto loan asset-backed securities. Those are the indicators that will tell you how far this correction has to run before the cycle exhausts itself. The auto market did not defy the laws of economic gravity during the pandemic. It suspended them temporarily on borrowed time in an environment of artificial scarcity and unlimited cheap credit. Both of those conditions are gone. The inventory is returning. The cheap money is gone. The buyers who drove the frenzy have already bought, and many of them are now locked in loans they cannot exit without taking a significant loss. The direction of this market from here is not ambiguous. It is not a matter of debate among the people who are looking at the actual data. Cycles do not ask permission before they correct. They do not negotiate with the beliefs of the people caught inside them. The bubble formed in silence over months and years while everyone told themselves the story they needed to hear to justify what was happening. The correction works the same way, quietly, then suddenly, and much further than most people expect. Stay patient, stay informed, and do not let the memory of where prices will convince you to ignore where they are going.